Hi everyone and welcome to the London session update with myself, Kathleen Brooks. On Friday the 5th of April 2013, well this is a special post-NFP roundup. We got the non-farm payrolls number out just half an hour ago and it was very weak. 88,000. That's much lower than the 190,000 the market was looking for and the 268,000 jobs that were created in February. Now there are a couple of things to really point out in this. Number one, it could have been slightly distorted by the falling of Easter. Also some of that very late winter snow that we saw in the US that could have disrupted things. But the other thing to point out is that we also saw a drop in the unemployment rate. How can that happen, I hear you cry, when the number of jobs created wasn't nearly enough? Because it's expected that 200,000 jobs need to be created to weaken the unemployment rate in the US. Well, it was because the number of people seeking work have dropped out of the workforce and the labour participation rate, so this is the number of people in the US, has fallen to its lowest level. This is a percentage of GDP, or as a percentage of the population as a whole, fallen to its lowest level since 1979. Basically, 200,000 job seekers last month just dropped out of the running or out of the index altogether. Now that could be because their unemployment benefits ran off, which is also not good news because it suggests that they're long-term unemployed. So overall, a very, very weak report. Now this has huge implications for the market. Number one, because we've actually heard some Fed members start to talk in quite positive tones about ending QE3 early. Well, this will really have set it back. So it looks like QE3 still very much on the table. The immediate reaction we've seen has been a big sharp move lower in the US dollar. Let's take a look here at euro dollar hourly. That's shot right up, as you can see. We got above 130 at one point, but as we pointed out in some notes recently, 130.20 has attracted some very good selling interest. So that's quite an interesting thing there. So we still think that euro's gains are going to be capped. That's after the ECB meeting that we saw yesterday. Growth is still very weak in the Eurozone and they're not getting any stimulus there to help that. So it's become a growth crisis in the Eurozone and that is likely to continue to weigh on euro. Even though we do think that the downside of euro dollar now is limited, especially now that we've seen that sharp drop in the dollar, those very weak payrolls, and also that sharp drop in the treasury yield. So that fell back 6 basis points after the announcement to 1.7%. Now, where we really saw a move was gold. Let's take a quick look at the gold chart. This is a daily gold chart. Gold has been hit very hard this week. It came off nearly 60 bucks, was trading well outside of its recent average range. And some of the reasons why people were saying, well, it's people getting a bit freaked out about what's going on in North Korea. You don't want to hold gold in that situation. You want to hold more liquid assets. But what we've seen is a big reversal. So as the dollar weakened, that meant the price of gold priced in dollars shot up. We got back above 15.50. Interestingly enough, we managed to hold even at its depths of selling off yesterday and the day before at that key support level of 15.25 to 30. That is what we're all watching now. That is key support on the downside. On the upside, 15.75 looks like it could attract a little bit of selling interest. So do watch out for that. Gold, as we'd said earlier, was our one to watch for this, and indeed it was that outlier number that really caused it to recover. We actually think because it had such a big sell-off, it may be able to stay above 15.50 at least into next week. So very interesting situation that we're in right now with the US and the Fed and QE3. Please do join us next week for more. Thank you.